In the closing weeks of 2007, Warren Buffett made a bet that most of Wall Street assumed he'd lose. $500,000, riding on a single question. Over the next 10 years, could a portfolio of hedge funds run by trained professionals using every analytical tool available to them beat a fund that simply sat there and did nothing? Ted Seides took the other side. He ran money at Protégé Partners, a firm built around identifying hedge fund talent before anyone else noticed it, and he didn't flinch. He assembled 5 funds of funds, more than 100 underlying managers between them, so no single bad year from any one manager could tank the result. Both men put up bonds designed to grow into $500,000 apiece by the finish line. 10 years. Whoever won would send $1 million to the charity of their choice. For a decade, that bet would sit in the background, quietly testing something almost nobody wanted to believe, that doing less, correctly, might beat doing more, expertly. Here's the myth this documentary is going to take apart, that getting rich and staying rich are the same skill, that the instinct which builds a fortune is the same instinct that protects one. They aren't. And the bet is where that difference starts to show. 2008 arrived, and for a while, it looked like Seides might actually be right. The market cratered. Buffett's index fund fell nearly 40% in its first year, a number that would have made anyone watching assume the bet was already decided. Hedge funds, built to hedge, lost less, roughly 24% on average that same brutal year. For a moment, the sophisticated side of the wager looked exactly as smart as its fees suggested it should. If the bet had ended there, Protégé wins, and this is a very different, much shorter documentary. That's worth sitting with, because it's the whole argument in miniature. The test was never whether hedge funds could survive a crash better than an index fund. Plenty of strategies can do that for a year. The real test was what happened after, once the panic passed, and the next 9 years had to be lived through one ordinary quarter at a time. Start with Buffett, because the easy version of his story, that he simply likes boring companies, undersells what actually happened. In 1988, he began buying Coca-Cola. On the surface, nothing could look less sophisticated. A drink that hadn't changed, a company that had existed for a century. But the analysis underneath that purchase wasn't simple at all. Buffett was pricing brand strength that competitors couldn't replicate at any cost. He was pricing pricing power, the ability to raise prices without losing customers, decade after decade. He was pricing a distribution network built over generations, the durability of the company's cash generation, regardless of what the broader economy was doing, and a demand curve that barely moved through recessions, wars, or changes in consumer taste. The company looked boring. The thinking behind buying it wasn't. That's closer to the real lesson than Buffett likes simple things. A simple-looking investment can still require serious analytical work. It just doesn't require repeating that work every week. In 1996, researchers Thomas Stanley and William Danko spent years interviewing actual American millionaires, not celebrities, not heirs, people who'd built their own net worth from nothing. The specific dollar figures in that research are dated now, but the pattern underneath it has held up. Most of these people didn't work anywhere glamorous. They ran ordinary businesses. They drove ordinary cars. They lived in houses that undersold what they could have afforded. That research tells you something true about how a lot of self-made wealth gets built. It doesn't, by itself, tell you how those same people invested the money once they had it, and that distinction matters more than it sounds like it should. Take a composite example, drawn from that pattern rather than any single real person. A pest control business on the edge of a strip mall, the kind of place you drive past 1,000 times without seeing it. The owner built that business by putting almost everything into it for years, reinvesting profit back into trucks and territory and staff, carrying real concentrated risk the entire time. That's how the wealth got created. But somewhere along the way, once the business was stable and the owner had something worth protecting, the strategy changed. The money coming out of the business stopped going back into more risk. It went into diversified, unremarkable funds, spread out, boring, untouched for years at a time. Building the thing and protecting the thing turned out to require 2 different instincts, and the owner switched between them without ever announcing it. That's the shift most of this documentary is really about. It's worth naming directly. Getting rich and staying rich are different games, run on different rules. Concentrated risk, big swings, betting heavily on one idea, that's frequently how fortunes get made in the first place. Founders bet everything on one company because a diversified bet on 100 companies was never going to produce the outcome they were chasing. Early investors bet everything on one idea before anyone else believed in it because spreading that same money across the market would have made them merely fine instead of wealthy. Concentration is often the price of admission for building something large from nothing. But once real wealth exists, the math of losing it changes completely. A 40% loss on a small, growing account is a bad year, survivable, even instructive. A 40% loss on a life's accumulated wealth is a different kind of event entirely, one that can take a decade or more to simply recover from, let alone grow past. That asymmetry between what a young account can absorb and what a mature one can't is why so many people who took enormous risk to build something end up looking almost conservative once they actually have it. It isn't a loss of ambition. It's a change in what they're optimizing for, from growth at any cost to growth that survives contact with a bad decade, which is where compounding comes in, because compounding is the mechanism that makes patience worth the trade. Historically, the U.S. stock market's long-run nominal returns have averaged somewhere in the high single digits annually, with real, inflation-adjusted returns running several points lower. Those are historical averages, not promises, and no single year looks anything like the average. Some years lose money badly. Others gain far more than the long-run figure suggests. The average only becomes visible once you stop watching individual years and start watching decades. Here's what that looks like in concrete terms, using a simple, clearly hypothetical example. $10,000, invested once at 25, earning an assumed 8% a year, with nothing added and nothing withdrawn. By 35, it's grown to roughly $21,600, respectable but unremarkable. By 45, about $46,600. By 55, around $100,600, more than the total of every prior decade combined. And by 65, roughly $217,000, more than half of which was added in the final 10 years alone. This isn't a prediction. Real returns don't arrive in a straight line. But the shape is the point. The early decades look unimpressive, almost not worth the wait, and the growth becomes disproportionate only once there's been enough time for it to compound on itself. Now put two 25-year-olds next to that chart, both starting with the same $10,000. One of them, call her the trader, is active and plugged in. Buy, sell, check the price, panic when it drops. Buy again on the way back up, hoping to catch the bottom. Some years that produces a spectacular win, and she tells everyone about it. Other years it produces a loss she doesn't mention, filed away quietly next to the others. Frequent trading isn't guaranteed to fail. It's simply working against a set of quiet headwinds, taxes on short-term gains, transaction costs, and a well-documented tendency for emotional decisions to land at exactly the wrong moment. The other one, call her the saver, does something almost embarrassingly simple. Automatic transfer. Close the app. Go to work. Repeat. Years pass. A recession happens somewhere in there, and she barely registers it beyond a headline. She isn't guaranteed to end up wealthy either. Markets can disappoint over any given stretch, and discipline alone doesn't manufacture returns that aren't there. What she has is fewer chances to sabotage the process and enough time for whatever the market does provide to compound without interruption. Finance professors Brad Barber and Terence O'Dean studied the trading records of thousands of individual investors, and their central finding reads almost like a description of the trader herself. More frequent trading was associated with worse investor returns in their study. Not a guarantee of failure, an association, but a consistent and uncomfortable one. The instinct to act, to feel some sense of control over an uncontrollable market, showed up again and again as a quiet drag on performance rather than an edge. The same pattern shows up above the level of any individual investor, which is really what made Seides' bet so interesting in the first place. His 5 funds weren't run by amateurs. They were run by credentialed managers, well-resourced, using sophisticated models, drawing on more than 100 underlying hedge funds combined, and they still struggled to clear a bar an index fund clears simply by existing. Each year, S&P Dow Jones Indices publishes a report called SPHIVA, comparing actively managed funds against their benchmarks across nearly every category, from large domestic stocks to international and fixed income. The finding repeats with remarkable consistency. The majority of professionally managed funds fail to outperform their benchmark after fees over long time horizons, and the gap tends to widen the longer the period measured. If people paid specifically to beat the market often can't do it reliably, that says something about how much of the promise is skill and how much is a good story. It would be dishonest to say boring always wins. It doesn't. Some active managers do outperform their benchmarks over long periods, sometimes by wide margins. Some concentrated bets on individual businesses have produced extraordinary outcomes for people who got in early and held through the discomfort of owning something the crowd hadn't noticed yet. Buffett's own fortune was built partly on exactly that kind of concentrated conviction, not diversification. But the existence of exceptional winners doesn't mean those winners can be reliably identified in advance, and the professionals paid specifically to find them, on average, struggle to do it consistently after fees, after taxes, after the survivorship bias that quietly erases every list of past failures. The exception is real. It's just very hard to find on purpose. There's a psychological reason boring is difficult to choose even once the math is understood. Speculative investing offers excitement, uncertainty, a feeling of control, frequent feedback, something to talk about at dinner. It gives you a story with a beginning, a middle, and, hopefully, a satisfying ending, updated in real time. A diversified fund gaining a modest amount every year offers almost none of that. It asks you to feel nothing while it works, which turns out to be a surprisingly hard thing to tolerate for months, let alone decades. Unpredictable rewards tend to pull people back toward an activity more powerfully than steady, predictable ones do, which helps explain why checking a volatile position can start to feel compulsive in a way that checking a savings account never does. In 2021, that pull played out live, in public, on a scale nobody could miss. A wave of retail investors drove the price of a struggling video game retailer up by staggering multiples in a matter of days, part genuine grievance toward hedge funds and market structure, part pure speculative momentum. Some of the earliest participants made real money, and the grievance behind the movement wasn't invented. But a spectacular short-term price movement isn't the same thing as durable underlying value, and a single profitable trade isn't a repeatable strategy. Once the momentum faded, the company itself was still a struggling retailer facing the same pressures it had before any of it happened. There's a tax dimension worth stating precisely rather than editorially. For most taxable investments in the United States, capital gains held longer than a year generally receive more favorable federal tax treatment than gains held less than a year, which are typically taxed as ordinary income. That means selling a winning short-term position can trigger a larger tax bill than selling the same gain a year later would, and every dollar paid out in tax is a dollar removed from the compounding process rather than continuing to grow inside the investment. It's a structural fact about how the tax code treats holding periods, not a moral lesson. None of this makes boring investing risk-free. Markets fall, sometimes hard, and staying invested through a serious downturn takes real discipline when the number on the screen is dropping and every instinct says, do something. But investors who stayed invested through downturns have historically tended to recover, while those who sold near the bottom locked in the loss permanently, often missing the recovery, since some of the market's strongest days tend to arrive shortly after its worst ones, right when almost nobody wants to buy. Which brings the story back to 2017 and the envelope closing on that 10-year bet. Buffett's index fund finished the decade up 125.8%. CITES' 5 funds of funds finished at 21.7, 42.3, 87.7, 2.8, and 27% respectively, an average nowhere close to the fund that did nothing. CITES conceded before the calendar even ran out. Neither man had been foolish going in. CITES was a genuine expert who believed sophistication would win over a full decade, recessions and recoveries included. He wasn't wrong because he lacked skill. He was wrong because the premise itself, that complexity reliably beats patience, runs against a pattern that keeps repeating across decades of financial history. Buffett donated the proceeds to Girls Inc. of Omaha. The bet that started as a provocation ended as a receipt. This is the turn the whole documentary has been building toward, and it circles back to Buffett himself. Even now, holding one of the largest concentrated equity fortunes in the world, Berkshire Hathaway keeps an enormous cash reserve on hand, far more than the business needs to operate. That isn't timidity. It's the same asymmetry showing up at the largest possible scale. The bigger the pile, the more catastrophic a single uncorrected mistake becomes, and the more valuable it is to simply survive long enough for compounding to keep doing its work. Preservation isn't the opposite of ambition. At a certain size, it becomes the ambition. The trader spends years trying to be right, over and over, about things that are genuinely hard to know in advance. Which company will dominate next year, when the next crash will hit, which headline actually matters, and which one is noise. Every one of those has to be answered correctly, repeatedly, just to keep pace. The long-term, diversified investor doesn't eliminate risk, and nothing about a longer time horizon guarantees an outcome. But a long enough horizon, combined with the discipline not to interrupt it, can quietly remove the need to keep making most of those predictions at all. That isn't the absence of sophistication. In a lot of cases, it's what sophistication looks like once someone has stopped needing to prove how smart they are with every decision. Somewhere right now, a version of Ted Seides from 2007 is building a new argument for why this time will be different, why the sophisticated bet will finally pay off the way it's supposed to. There's nothing foolish in trying. Someone, somewhere, will occasionally be right. Somewhere else, a 25-year-old just opened an account, put in a number too small to feel significant, and closed the app without a second thought. Neither of them knows yet which decision they've actually made. There's no ceremony to that second choice, no moment that feels like the beginning of anything, just an automatic transfer, set once and mostly forgotten, quietly doing more work over the following decades than almost anything either of them will consciously decide to do in between. Decades from now, one of them may look at that account and barely remember opening it, the way you can walk past a strip mall for years without noticing what's actually happening inside it. The secret was never a hidden investment nobody else could find. It was restraint. Not knowing more than everyone else, but needing to guess less.